Michael, how would you categorize the bull market in terms of what stage we're in right now?
Well, I haven't seen that whole note, but I would comment that I think the economic cycle for this country and in certain respect many other developed markets is really being stretched out for a very considerable period of time. So it doesn't necessarily go down that much and it doesn't really go up that much. And against that context, I think some of those historical comparisons to earlier periods are it's a little bit apples and oranges. I'm of the view that if the GDP in this country, the basic global macro backdrop holds together, I think PEs can continue to expand for quite some time. And that 18 or 19 as a PE on the S&P 500, for example, isn't necessarily a constraining constraint. I think we could go well beyond that. So I'm more of the view that maybe we're in the 5th or 6th innings of this bull run and not sort of the 8th or 9th.
Can we pull back that chart of the volatility, the VIX one that Alex was just talking about, Amy? Because that, of course, is something you look at very carefully, Michael. This idea that we're in a stormy period right now, this cyclically volatile period. But the VIX, having said that, is now below 20, and it has been since October 5th. So does that signal calm or complacency to you?
I think, it's interesting. If you look at the VIX over the last several years, one of the charts I'd like to do is sort of overlay the aggregate central bank balance sheets on top of that. And you can see that basically it kind of moves with that. As central banks are adding to their balance sheets, the VIX tends to go down. And so I think, having call it a 14 to 20 range is not necessarily a sign of complacency with that type of central banking backdrop there. If we got down to 10 or 9, I think that's very different. But I think the bar has it's kind of needs to be reset given what's happening with central banks.
Bloomberg News had a really interesting article out today talking about the demand for long and short volatility products are both around record highs. So the idea being if there's some kind of huge spike, you're going to get a lot of longs coming in, you're going to get a lot of short covering, and that could really distort the entire market. What would you think about that?
Well, again, I think the volatility framework I'm working with is that so long as disinflationary forces are going to continue to motivate central banks, and you're seeing this more and more and more. Maybe the BOJ not last night, but generally, we saw it out of the ECB. We've certainly seen it out of the Fed. They're more and more interlocked with each other as these currency dynamics play out. I think that's the volatility will ultimately. The central banks are too powerful a force in most cases. Now, China is a wild card here, right?
Yes.
And that doesn't have a developed market central bank and a whole QE program, as we know it in the U.S. and the Eurozone and Japan. But I think what's happening there is that you're starting to see them behave a little bit more proactively as you've seen here in the United States. And I think that's going to be one of the interesting evolutions there.
So easing from central banks like the Bank of Japan when it does do something, the European Central Bank when it does do something, the PBOC, that's enough to make up for the eventual tightening by the Fed and the Bank of England?
It goes a long way. I mean, you can certainly see that in when you have negative yields in the Eurozone on sovereign paper in Germany and so forth. That helps suppress our interest rates over here. Now, the other dynamic, of course, is, does the dollar get too strong in the process, right? And that's something that I think we're seeing. The Fed, they don't like talking about it, but they're increasingly sensitive to that. And, so far, the dollar, even off last week, has strengthened, but not too fast.